Hey, my name is Morgan Tate. I'm a business broker that has sold over 40 businesses in the last 3 years. And today I'm going to talk about some of the red flags that you as a buyer should avoid when you're looking to buy a business. And I'll just say I've kind of seen them all. I'm representing lots of sellers, so I'm going to give you my broker's opinion, my full transparent opinion on what you need to look out for when you're looking to buy a business. So number one is going to be an owner saying they make a lot more money than it seems to make on paper. So every business, typically, if you're an owner operator, has some tax optimization strategies they'll do with their accountant. So whether they're writing off equipment with amortization, depreciation, these are all legitimate expenses that actually reduce your tax liability, but you don't pay them out of hand. So when you're paying for depreciation, it's actually not an out-of-pocket expense. So when we're calculating cash flow to the owner, we actually will show that, we'll take that expense away and show the higher profit. Same with an owner paying themselves a above market salary. So let's say they paid themselves $250,000 a year. However, they don't really work full-time in the business. That is obviously money that's still going in the owner's pocket. So we consider that in the profitability. All those things are fine. Where we start to get into the red flag territory is when the owner starts listing a laundry list of tax write-offs that may or may not be legitimate. The tax returns don't really match up with the QuickBooks or their bookkeeping software, and they're getting paid cash or things like that. So what we always say to clients is that we can only represent the profitability that we can see that's on paper. And as a buyer, the screening question you're going to want to ask is, can I see your corporate tax returns? And go off of what they've reported to the government and use that in your assessment of the profitability. Red flag number two, the owner seems to be doing 12 different jobs within the business and they're working like crazy. This one is super common and often comes up with sellers. And so maybe they're doing the customer support and they're also doing sales and they're doing the fulfillment of the labor. What I've done as using a screening question for this, because you don't want to step into a business where you're going to be working 100 hours a week if that's not what your goal is, and it's not what most people's goals are. So how you can screen for that question is asking the owner if they've been able to take a vacation longer than a month in the last 3 years. And if they answer, oh, I like working, I don't want to take time off, then say, could you take more than a month off if you were to leave the business, or would everything go south? And that will be a pretty big determinant of, one, if they're being honest, but also how dependent the business is on that owner, because you're going to have to replace that owner. And if you're not able to do those 12 different jobs, it's going to be a problem. The third red flag is that there's no long-term staff in place. So when you ask for their list of employees, they all seem to have started recently and there's a very high turnover. Some industries, this is a bit more normal, where there's seasonal work, or it's more like a retail job where you have maybe student workers that come and go each year. But if you have let's just say like an HVAC or plumbing business where your technicians are kind of expected to be there for many years, that can be a big red flag. So what you can do is look at, can I get the records of employment, or at least the start and end date, an exhaustive list of everybody you've hired over the last 5 years, and then you can kind of build an average tenure. And you can cross-reference that with looking at Glassdoor reviews, LinkedIn, turnover, that's for people that have said that they've been working at XYZ company. And you can start to build a bit of a consensus on, hey, what is the workplace culture like and what's this company's reputation? The final red flag, number 4, is a majority of the revenue is coming from one single customer. This is a big one. So if you look at their QuickBooks profit and loss statements, or if you want to verify it even deeper, their chart of accounts and their general ledger, looking at the list of customers, and if you notice that one customer is making up 20, 30, 40, 50%, sometimes this can be as high as like 80% in certain businesses, that is going to be a big red flag, because if you were to take over that business and that customer to leave, obviously you're going to be left on the hook. There's a bunch of ways to mitigate this strategy, which I talk about in another video, which is too long for this. But your screening question there is, again, going to be asking for more documentation, due diligence, Probably the best here is going to be going into the general ledger of the business and really getting the detail, and then also seeing if you can get into the QuickBooks to see, or whatever payment provider they get, to see the money flowing in and out of the bank account from the actual customers themselves. So there you go. There's 4 red flags to look out for in your search for a business, and make sure you don't get burned out there.